All right, so our next reading is investors and other stakeholders. First of all, in this reading and in the first LOS, we are going to talk about the different claims or the conflict of claims or conflict of interest between the shareholders and lenders. So, why the conflict is creating? Why there is a conflict between the lenders and the shareholders? The conflict the reason of this conflict lies because of the difference in claims. The shareholders have different claims, lenders have different claims. So when we talk about, for example, by looking on the balance sheets, the lenders, they have the priority. So first of all, we will use or we will satisfy the liability first. We will pay debt holders or we will pay creditors, we will pay lenders. In other words, we will satisfy all of the company's liability at first. Then if there's any remaining, whatever is remaining after paying all of the liabilities, after satisfying all of the liabilities, that is a net assets, that is a residual. So this is the claim of equity holders and this is the claim of the lenders. And when we talk about the sources of finance, so we broadly divide the capital or source of finance into two categories. On one side we have debt, on other side we have equity. Clearly the debt is a cheaper source of finance. Why? Because of this priority, because lenders have priority, so debt is less risky, so it is a cheaper source of finance. And from the lender's perspective it is less risky, from the company perspective it is cheaper source of finance. So when the shareholders or the company management will be deciding between which source of finance we are going to use, debt or equity, so clearly they will prefer debt because debt is a less costly from the company perspective. But when the company start increasing or start including more and more debt in their balance sheet, so the risk of the company, the leverage of the company will start increasing, which makes the company more risky. Okay, so why when the new lenders or when the new bond holders or new debt holders or new private lenders, when they will analyzing the company's balance sheets or company financial statements, and uh, they are deciding that whether we should provide the loan to this subject company or particular company or not, they will be analyzing all these factors. Okay, and secondly, the most important point here is, although as I said, debt is less risky, okay, but lenders, the maximum they can get, the best they can get is their interest and principal. This is what they are demanding. They are not concerned about growth of the company. I mean, not altogether they are concerned, but they are less concerned. Their concern is they should be paid their interest and principal on time. Okay, so by taking the loan, by taking the debt as a source of finance, as in capital, what shareholders are going to do, they will use that capital for the growth of the companies, because shareholder concern is growth, shareholder concern is profitability of the company, but lenders concern is their interest and principal on time. So when the shareholders are including more and more debt in the balance sheet, in the source of finance, in the capital side, that will increase the leverage, that will increase the risk for the new lenders. So lenders will say, okay, if the companies are taking more and more loan, what they're going to do with that, they're going to expand. So if company expands, if companies creates or generates more and more return, what are we gonna get from that return? Nothing, because lenders, they do not have any upside, they are not getting anything. So the best they can get is the interest and principal on time. But why they are opposing this, why they are opposing the increasing level of debt, or why it is a warning sign, why it is a matter of concern for particularly new lenders, because including or increasing the debt level from the company perspective, increasing the risk. And this increase of risk, this increase of leverage is not beneficial to the lenders. Yes, it can be beneficial to the equity holders, because if the company is increasing leverage, and as long as the return on asset is greater than the cost of debt, so company will be increasing the debt, because we are generating the capital, we are raising the money at lower cost, and we are generating more return. Our assets, we are putting that money into the assets, into the investments which are assets for the company, so we are generating more return compared to what we are bearing the cost. Okay, so from the shareholder perspective, this the higher the return or increase in return or upside potential, these all the benefits will be enjoyed by the equity holders. But lenders, they are not going to get any upside. But why they are opposing, the major reason is they will say that the debt is increasing, so the risk is increasing, because the gearing, the leverage, everything is increasing. Okay, so because of this, they will say we are not going to get any upside, but yes, we have the downside risk, although debt is less risky. But if the company's debt level increases beyond certain level, the leverage ratio increases beyond certain level, or the companies are not able to meet the coverage ratios, the minimum coverage ratio decided or set by the lenders in the bond indenture or in the contract, so this is exactly the reason of conflict. The lenders are saying, I'm summarizing, lenders are saying that if the shareholders or if the company management decides to increase the debt level, and companies are generating higher return on assets compared to the cost of debt, this benefit will go in the pockets of shareholders. But because of this increase debt, although the return is increasing, but this return uh, is because the companies are taking a higher risk. So this perspective or this higher risk will be affecting the lenders, but lenders are not going to get any piece of cake from this return, but they are affected by this factor, which is risk. So that's why they are opposing. On the other hand, because the shareholder concern or equity holder concern or owner's concern is growth, is expansion, is profitability of the company. Okay, and they are going for any source or any capital or any aspect which can give them return, higher return compared to their cost. So one of that source is debt, which we are talking about. And we can also analyze this conflict of interest from this equation. So when we talk about the total value of a company, that is basically the equity value and debt value. So if the value of company is increasing, who is going to get benefit from this increasing value? Clearly the equity holders, because debt value remains constant, it is unaffected, because their benefit, their concern, which is interest and principal, is decided. But on the other hand, if the value of company is less than the value of debt, so in this scenario the value of equity will become zero, because the company's assets are not enough to satisfy the debt. Some of companies may be defaulting on some of the debts probably, but in this scenario equity holders, they are not going to get anything because their claim is residual. But in this scenario nothing is residual, because if I write it in the equation which we have, the assets minus liability, so our assets are below our liabilities, so companies technically is in the default scenario, right? And so this exactly is the reason that if the companies are increasing the debt level, that debt level can increase the risk of the companies, and if the company becomes more and more risky, the chances of default would be higher in that scenario. Although equity holders, by the way, in default scenario, both the equity holders and debt holders, they can lose their entire investments. But again, the debt holders, they have some sort of saving in a way because they have priority of claim. But again, they are facing the risk. They are at the bunch of this risk that we may lose our investment, right? So this is the reason of conflict. We can also understand this conflict by looking at this equation. So if we go for equity, which is 100% equity financed, nothing debt, no leverage, so our return on equity is 20%. But if we include the debt in our capital, our because obviously our cost will go down, so my return on equity will be higher. On both scenarios we are assuming the same return. So if we go for 50-50 ratio, 50 debt 50 equity, so my return on equity is higher. So this higher return on equity is saying that because we are taking higher risk, clearly in this scenario the risk is higher because the debt is involved. Okay, and so leverage is increasing, so the risk is increasing, return is increasing, and this return, this ROE will be increasing or will be beneficial as long as the return on assets or this return is greater than cost of debt. Otherwise, if our return in the second scenario, in this scenario, is less than the cost of debt, then what is the benefit of including debt, cheaper source of finance, in our capital structure? We are including debt in our capital structure because it's a cheaper source of finance, and we are including this because, and if including debt can cause our return to be higher than the cost of debt. But as I said, the risk is increasing from the company perspective as well as from the stakeholders perspective, which we are subject stakeholders right now is the lenders and shareholders. But this higher return on asset, the question is, will the debt holders get benefit of this higher return on assets? No. As I said earlier, their claim is decided, their claim is fixed. So what's the bottom line? Bottom line is that the claim of debt holder is fixed. They are not going to get any upside, but they are facing downside risk, even though they have priority. As we said, in the event of default, both the debt holders and equity holders can can lose their investment. Okay, so yes, they are facing the downside risk, but they do not have any upside. On the other side, the equity holders, they have upside, they clearly have downside because their claim is residual. So this creates the conflict of interest because both types of stakeholders, lenders and equity holders, they have different risk profiles, they have different interests. Okay, so because of this, the conflict is creating. Debt holders, they are primarily concerned about interest and principal. They are less concerned. Okay, obviously, as the company grows, the ability to satisfy the loans will be increasing, but that comes at a risk. For example, continuing the same example, that what if our revenue decreases by 15% to $88.50. So in this scenario, my return on equity has fallen to zero. This is what we are talking about. Now, any further decline in revenue will cause this structure, because of this structured income statement, debt 50 equity, any more than 15% decline in revenue. So let's say if the revenue is 800, we will be at a loss of $50. Okay, so this exactly is a conflict. Now, why the equity holders, they are not going for issuing further equity? The reason is two. Number one reason is, as I said earlier, from the equity holder perspective, because equity holders, they have the residual claim, they do not have priority, their claim is not fixed, promised, decided. So the cost of equity is higher compared to the cost of debt. So equity is an expensive source of finance. So because of the one of the reason, maybe they are not going for equity as a source of finance, because the required return of equity holders will be higher than the debt holders. I'm talking about from the company perspective, let's say company A. Okay. And secondly, the existing shareholder of this company will oppose issuing further equity as a source of finance because of dilution. So, two reasons the existing shareholders are opposing issuing the equity or raising the money by issuing further or new shares is because obviously their control will be diluted, and secondly, cost of equity is an expensive source of finance. So because the debt is a cheaper source of finance from company perspective, so they will prefer the debt obviously. Then now when the companies are taking more and more debt in their balance sheets, in their capital structure, creditors are facing, lenders are facing risk. But now, how the lenders can protect themselves? This is called creditors mechanism. We'll talk about in higher detail at the fixed income about this mechanism. So one of the way they can do is they can prevent or they can protect themselves is by entering into a bond indenture or the contract, right? So in the contract, because bondholders or lenders, they have to protect themselves because they are at the edge of this risk. The particular risk we are talking about is that the companies may be involved or may be inclined towards taking more and more debt. There must be a limit, there must be a, they must draw the line, right? So to prevent this, to prevent themselves, the lenders, they will draw the line. They will say that okay, the maximum leverage ratio is 50%, not more than that. Okay, now if the ratio, as long as the ratio is 50 or below, let's say the ratio is 40%, so that means the company can take debt. Okay, 45% company can take more debt. But if the ratio has reached at 50%, that means you are at the edge, you cannot take more loan, you cannot take more debt because of this contract. So maximum leverage is decided depending upon, I mean, it's all about credit analysis, they will use models, different things. I mean, what is the appropriate leverage ratio, that will be decided, but that's not our concern here. Or they can decide the minimum interest coverage ratio. What is coverage ratio? EBIT over interest. For $1 of interest expense, how much we are making in operational profit, operating profit, earning before interest and tax. So clearly, higher the ratio, better it is. So that's why the lenders, they have decided, they have set minimum interest coverage ratio. So let's say the minimum interest coverage ratio is 5x. So that means at any time company must be generating 5 times profit. The profit must be 5 times of the interest. So if interest is $1, the profit must be $5, or interest must be lower. And this minimum interest coverage ratio requirement will also limit, will also force or will also prevent the company by taking more and more loan, because increasing the debt, including more and more loans in your capital structure, means interest will be increasing. And if the interest is increasing, interest coverage ratio may fall down. Okay, so You have to maintain the minimum interest coverage ratio, right? So these are the you can say ways through which lenders can protect themselves. So now we have two theories. One is the shareholder theory and one is the stakeholder theory. Shareholder, they are the stakeholder, one of the stakeholders. So who is the stakeholder? Any person or any group of companies or different groups who have interest in your company, right? So it can be shareholder, it can be government, it can be managers, it can be lenders, it can be suppliers. So what the shareholder theory says, what you need to remember, what the key word that you need to understand here is, when we are talking about shareholder theory, the primary focus of the corporate governance is the protection of shareholder, is managing the interest of shareholder, preferring the shareholders. Okay, so what is the interest of shareholders? Maximize the value. So you can say that under shareholder theory, the corporate governance aim is to maximize the value. Also, when we talk about shareholder perspective, from the shareholder perspective, the major conflict that arises is between the shareholder and the managers when we are talking about the company perspective. So under the shareholder theory, the aim is also, the primary concern is also the to manage the conflict of shareholders versus the managers, which is called principal agent conflict. Because shareholder concern is maximize the value, and to maximize the value, their personality, or they can take more risk, or they will be willing to take more risk. But on the other side, the managers, the board of directors, they may not be willing to take more risk. We'll talk about in more detail the conflict between the managers and shareholders in the upcoming reading. And then the more general stakeholders theory, this is a broader. Here, the corporate governance aim is protection of every, or managing the conflict of interest between all the stakeholders. So let's talk about the different interests, or what is the concern of shareholder, what they want, what is their claim. Their claim is residual, because they cannot claim all the assets. So their claim is residual assets minus liability. Once all the liabilities have been satisfied, whatever remaining is, that is shareholder interest. That is your shareholder claim. And other than that, shareholder interest is in the profitability, because they want, their interest is maximizing the value of the company. Okay, growth of the company, that is their concern. When we talk about lenders, so we divide the lenders into two categories. We have the public lenders, or the public bond holders, versus the private debt holders. The private debt holders, best example is the banks. I mean, they are giving the loans on a privately basis. That is a private negotiation. When we talk about public versus private, clearly the banks will be falling in the private category, and in the public, it can be anyone. So let's say the Apple have issued 100 billion worth of bonds. Now anyone can invest in this bond. Okay, so they are raising the money through bonds from the public market. Okay, now clearly when we compare the excess of information, or level of information that bondholders and private debt holders have, public debt holders, they have less information, they have less access to information. So let's say this is XYZ company, and there is a private lender, which is the bank, and there are a lot of public investors, public bond holders. So clearly the level of information that bank have, because of their relation, because of their status, or because of the nature of their relation, they will have higher information compared to any public bondholder. Although in the eyes of company, both are the lenders. Public bondholders or the bank, they both are the lenders. So the point here is, as in bank, they will have a greater access to information. They can have, they can access the non-public information which is not yet available for the public. Okay. uh, okay, so now when we talk about banks, so generally banks are giving loans to XYZ company, and we have discussed the conflict of interest at the start. We have discussed what type of risk the lenders are facing. To manage that risk, or to take part in the policy making, the banks can purchase the equity of the same company to which they have provided the loans. Okay, so in this way, now let's say from the XYZ perspective, bank is the lender as well as the equity holder. So now, as in lenders, they have the priority. They have the, kind of downside protection because of priority of claim. But as an equity holder, they have the voting rights, they have the decision making power. So obviously, they will be making decisions, or they will be making decision in a way that is to protect the lenders. Okay, so they will be setting policies so that the chances of default of XYZ company will lower down. They will go against any policy, any decision, any sort of investment which can increase the risk. So now, because of this policy, because of this style is lenders will be investing, will be purchasing the equity of their borrowers. Like in this scenario, the bank is lender for XYZ company as well as equity holder for XYZ company. Now, as an equity holder, the bank will be enjoying upside potential. As in lenders, bank downside risk kind of will be managed or protected. Okay, so what are the board of directors? What is their interest? As I said earlier, and we will be talking about further in detail, their concern, their risk is protection. To protect what? Interest of shareholder. So their sole interest, or their major concern or major interest is create value for shareholders, placing the interest of shareholders above their own, because they have the fiduciary duty to act in the best interest of shareholders, right? So their major interest is protection, or creating value, maximizing value of the company, creating value for the shareholders. So other one, the general can be hiring and firing and setting the compensation for senior managers, establishing the strategic direction of the company, monitoring the company's financial performance, and all others ongoing activities. So these are the board of directors interest. When we talk about board of directors, we have two types of directors. Some are inside, they are the executive directors. Okay, so we also call them as an ED. And some are independent directors. These are called non-executive directors as well. So inside directors, they are on the payroll of the companies, they are employee of the companies. But independent directors, they do not have any material relation with the companies. What are their aim? Why they are hired for? Okay, so they are hired for to manage the conflict of interest between the shareholders and directors, right? So their concern is protection. They will protect the shareholders' interest. That is because they do not have any material relation with the company, so they will not have the conflict between themselves and with the shareholders. In European, particularly in Germany, we divide there are okay, so when we talk about the board structure, we have one tier and we have two tier. In one tier board structure, both the independent directors and the inside directors or executive directors, they sit on the same board. Okay, but when we talk about a two-tier structure, in two-tier structure, the non-executive directors, they sit on a board called supervisory board, and their aim is to supervise executive directors or management board. Okay, another point here is staggered board. What is staggered board? Let's say shareholders wants to remove all the 10 directors in a board. Okay, so if they remove all 10 directors, or let's say all 7 directors, then there will be a major overhaul, there will be a major overhang if there is no directors for that time being. Who will be running the company, who will be managing the company? And removing all directors at once will also send negative information to the market, to the investors. So there's a concept of staggered board which says that all the directors cannot be removed at once. Okay, so if let's say there are 7 directors, the policy can be such a way, or corporate governance can be such a way, that 3 directors per year can be removed, okay, or can be fired. So that means if the shareholders wants to change or wants to set up altogether a new board, that means they have to wait at least, I mean, 2.5 years, right? So this is a staggered board. What are the senior managers? What are their concern? Their concern is remuneration. Their concern is company performance, because their bonuses can be linked with the company performance. So better the performance, higher the bonuses, higher the perks. Okay, so like for example, they can medical allowance, house allowance, insurance allowance, different things, different perks they will be getting. And most importantly, their concern is also job security, continued employment. Also their concern will be growth prospects, career prospects, right? So though these are their claims, these are their interest. When we talk about human capital, these are the laborers and skilled employees. Clearly, their concern on the first hand, their concern is job security. And job security is again linked with success of the company. If the companies are growing, companies are sustainable, they will be facing, the employees, the labor, they will be facing less risk or regarding their job. Okay, and they also have a concern regarding the rate of pay, the opportunities for career development, the training, working conditions, health and safety, everything. Sometimes the companies give stock options. Stock options align the interest of the shareholders or the interest of the company with the employee interest. And we will discuss the stock option at higher detail at level 2, but how the stock options align the interest of the company with the employees, or interest of shareholders with employees. So let's say employees are given a stock option, or employees are given an option to purchase the shares at $20 per share. Now there is an eligibility criteria. So let's say very simplistically, one of the eligibility criteria is the service period. So to be eligible for this option, employees have to work for, let's say, at least 5 years. Okay, and right now at the time of this at the time when this option is being rewarded or being provided, is let's say the price is $10. Now why the employees will be willing to purchase the shares at $20 when they can purchase at $10? Look, this $20 is not now, it's after 5 years. Okay, so companies believe that when you, the employees, let's say, will be working in the company, they will be creating the value, and over the period of 5 years, we believe that because of the employees performance, because of the employees productivity, all that, because of the invention and all that, the share price will be higher than today's price, right? So now employees will be motivated towards productivity. Their productivity will go up. So this is how the employee's interest can be aligned with shareholder interest. Then we have the suppliers. Suppliers are the creditors. First of all, their concern is a long-term relation. Their concern is in the profitability. Suppliers, obviously, if the companies are making more and more profitability, they will go for expansion, and the suppliers will be able to supply more. So suppliers have their personal interest, obviously, and suppliers are also concerned about growth and ongoing stability, because if the companies are stable, if the companies are growing, that is in the best interest of suppliers as well, right? uh, Customers, they are concerned about high quality at reasonable price. They also want, let's say, if they are the business customers, B2B, so their concern also have the long-term relationship with the companies, after sales services, all that. Obviously, the companies have to protect the customers, because they, for the long-term success of the company, satisfying the customers or maintaining the goodwill of the customers is crucial for the company long-term success. And if customers are concerning, like in the modern day, in the modern environment, customers are being concerned about ESG, environmental, social, and governance. Particularly, they are concerned about environmental and social. So companies have to take care of these factors. So let's say if the companies are involved in pollution, companies are exposed to social risk, like they are not taking care well of their employees, of their health and safety, or they have been, or they were involved in the breach of confidential customer information. Okay, so obviously customers will be reluctant in future from buying the goods from that company. Okay, so maintaining the environmental and social factors are very important for the companies in modern environment. Governments, when we talk about government, so their concern is tax revenue, but other than that, obviously their concern is economic growth. By the way, obviously, if the economy is growing, companies are growing, this will lead to higher tax revenue. Also, they are concerned with the social welfare, employment creation. So if more and more employment opportunities are creating, so that means the purchasing power of general public will increase. Spending level of governments will go down, because the purchasing power has been increasing. Now the governments have to spend less on the employees, or on the public, on the general public, right? And also, when the purchasing power is increasing, so employees will be willing to spend more, the growth, economic growth will increase, and this will lead to higher tax revenues. Now let's talk about environmental, social, and governance. In the modern environment, this ESG has become so much important because of three reasons that we are going to talk about. Number one reason is government. Government have so much concern about particularly climate, social policies. So governments are taking all the measures to protect the climate, to protect the environment, like for deforestation, for pollution, all that. And so that's why there is an increasing trend of electric vehicles, because of the limitations or environmental regulations regarding the footprints and the social policies. So now in the modern environment, companies have to take care of the environments. Companies have to, their machines should be efficient, should not be creating pollution, and they have to take care of the social factors. They have to, if they have any confidential information about their employees, about their clients, about their customers. So they have to manage that information. They have to that information must be highly secret. Secondly, if the ESG factors can have the impact on the goodwill of the company, as well as can lead to financial losses for the company. So let's say if the companies, they are not taking care of the environment, or they are in breach of social factors, or they have the weak corporate governance, so they can end up having lower goodwill or losing the goodwill. On the other side, if the companies are breaching or not taking care of the environment, so they should be ready, or they will be fined by the government, so they can have the financial loss, and all that lower goodwill, fine or penalty by government uh, can lead to reputational damage for the company, which is obviously not good for the company as well. Negative externality. What is negative externality? Is the when let's say companies are creating pollution, and why the pollution is being created? Because they are producing the goods, and who is getting benefit from that production? Company, because they will be making sales, they will be making profit, but who is bearing the cost? The society. The society, the community, who is being polluted because of the actions of the company. This is called negative externality. So let's talk about ESG, environmental factors. So what are the environmental factors? So when we are talking about environmental factors, what we are analyzing here, we are talking about how the environment affect the company, or how the company is affecting the environment. So we will be analyzing both how the company is affecting the environment, and how the company is being affected by the environment. So for example, there can be the climate change, how the company contributes to the global warming, or how the company is impacted by the global warming. And then we have the air and water pollution, the deforestation, energy efficiency, all that very simple straightforward concepts. But now, how this climate change can have impact? We have the physical risk, we have the transition risk, and we have the stranded asset. What is a physical risk? Physical risk is damage to assets or operations from the extreme weather, for example, floods, storms, or drought. So, if the factory is near the coast, it can be damaged by rising sea level. So, physical risk is basically the adverse effect of environment on the company's assets or operations. And so what is the transition risk? So transition risk is because of the new regulations. So let's say if the governments have said that they have set the efficiency level, or a government have regulated or passed a regulation that what there is a minimum, so government basically wants to reduce a carbon emission. For that, obviously, if used or old machineries, they will not be efficient, or they will be creating high pollution. So we have to change that machines, we have to replace that machines with the new efficient machines. This is the transition risk. So transition risk is losses when we shift towards low carbon activities. So now, what is the stranded assets? Because of this physical risk, or because of the transition risk, the older assets, or the assets that are or that have been affected because of these risks, they are not viable now. We cannot use those assets. Okay, that lose their value or become unusable because of environmental regulations or changing market preferences. These are the stranded assets. So what type of cost the companies can bear? Because if they are polluting the environment, it can be penalties, it can be cleanup cost, it can be litigation cost, it can be in terms of losing goodwill. Okay. So when we are talking about social factors, we are concerned about customer privacy. We are concerned about information security. We are concerned about customer satisfaction. We are concerned about employees engagement, diversity, inclusion, labor relations, and community relations. So companies have to take care all these factors when we are talking about social factors. So you need to remember these points from the perspective of social factors. So when we talk about social factors, we are also talking about, let's say if we are talking about employees engagement, how the companies are treating their employees, how the companies are treating their customers, so how the companies or the businesses are treating their communities. Okay, so if the companies are well managing their employees, their customers, the communities in which the company is being operated, then obviously the social risk will be lower. Social risk lower means employees productivity will be higher, which will be beneficial for the companies, because if the companies are taking care of their employees, if they are engaging well with their employees or managing well their employees, their labor turnover will be lower, employee productivity will be higher because employees will be motivated. And if they are, if we are treating our customers very well, if we are protecting our customers privacy and their information, then the customer loyalty will be higher, and all that will lead to less risk of litigation. Like if we are treating well our communities, if we are managing well or taking care of our customers and employees, all that will lead to low risk of litigation. So what we talk about in governance, we talk about the structure of the board, the composition of the board, what should be the executive compensation. I mean, obviously, the compensation we'll talk about in more detail in the upcoming reading, that how or how the compensation should be linked. Like let's say if the compensation is linked with the EPS or with the profit, then the management will be motivated towards the manipulation of profit or towards the manipulation of EPS. So compensation should be decided in such a way that is beneficial towards the both the managers or the board of directors, as well as in the benefits of the companies as well. Then the governance also talks about that there should be no bribery, corruption, political contributions, lobbying. The main aim of corporate governance is that do we have the sufficient or adequate systems, or are we complying all the laws, rules, regulations? Are we taking care of the interest of shareholders? Are we taking care of interest of all our stakeholders? Are we complying all laws, rules, and regulations? And do we know that what are the changes are being made in any regulations? Because if there are changes being made in the laws, rules, and regulations, and we are not aware of that, so we may end up not complying with those laws, rules, and regulations. And this excuse will not be accepted, that because we were not aware of this change, so unintentionally we breached this law. This excuse will not be acceptable. And the last point, very simple, is that as an analyst, so when we are evaluating the companies or businesses or analyzing the businesses, so we need to take care of all these. Other than all other factors, the financial factors, we need to consider these factors: environmental, social, and governance in short term and in long term.